Good morning, everybody. It is May 4th, 2023. Want to look at a couple of the interesting things that are going on in the market, although there's a hell of a lot of interesting things going on in the market. But this morning I'm just kind of contain it to five, but keep checking back to our YouTube page here, Stock Market Jobber, and let's take it from there. So with all the hoopla of the Fed meeting, this, that, and the other thing, market looks pretty weak. This is SPY, the S&P 500 ETF, and it's trading below this important level here, which is about 408. Now, certain levels are more important than others in the market. That's just how it works. Notice how the resistance here was resistance here. So this is January, and this is a few days ago, and somehow the market remains, or the market memory tells us or tells it where that resistance should be. So here we had resistance at 408, then it became support. This happens because of buyer's remorse. There's people who, I'm sorry, this happens because of seller's remorse. Sorry about that. I'm a little confused here. So people sold here and they thought they did the right thing, and then the price goes higher, and a lot of them tell themselves, I made a mistake. I'm going to buy my shares back, but only if I get them at the same price I sold them at. So if you have enough remorseful buyers, or sorry, sellers placing buy orders, the level that was resistance can become support. Here we have support becomes resistance. This is the exact opposite. This is buyer's remorse. People buy, the price goes lower, and then a lot of them regret doing so, and they tell themselves they want to get out, but they're only going to get out if they can do it at break even. So we have remorseful buyers placing sell orders at the level that was support. Then, as we can see, it was important over here. So even though we went through it here, I still think that this is an important level. My guess is that we keep going lower and we probably find some support down around the 400 level. Our financials are weak. That's probably the biggest story. And speaking of that, I just wanted to point out this Icahn Enterprises story. You may or may not have heard, but there's a firm called Hindenburg Research, which, as far as I can tell, they've had a pretty good track record. And what they do is they find companies that they think are overvalued, or maybe there's some monkey business going on. Now, they went after Icahn Enterprises, Carl Icahn. This is a big story because, or it could potentially become a big story because Carl Icahn is like a legend. I mean, he's a Wall Street icon, no pun intended on his name. But this would be a really big story if this is true. I don't know if it would have the size and scope of a Madoff, but it would be pretty bad. I mean, it would be part of Wall Street history and not in a good way. Now, I don't know much about Icahn. I don't know much about Hindenburg, but I do know stocks. And this report came out 3 or 4 days ago. And notice this, there's been no rebound whatsoever. What does this tell us? Well, this tells us that people who are interested in this company, or maybe were holders of it, do research and they start to see things that, like, oh, maybe Hindenburg was right about that. Maybe Hindenburg was right about this. One of the things that they pointed out is that his stock, IEP, is trading at a 200% premium to the assets that are in it. Just to put that in perspective, some of the other well known firms that do the same thing that Icahn does trade at a 20% discount or a 15% discount. So to trade at a 200% premium is pretty, it's an, let put it this way, it's an outlier. It's far and away the most highly valued in this sector or this area where there's about 500 and some odd companies. Now, one of the things that people find attractive about this particular stock is it pays a really high dividend. It's about 15%. In this part of the market, the next highest is below 10%. So 15% dividend, that's very compelling, very attractive. But what they're alleging is essentially a Ponzi scheme, taking new money in to pay taking new money in to pay the older clients off. So Ponzi schemes tend to come apart like a house of cards. I don't know what's going to go on here. I don't know who's right, but the fact that the stock price hasn't come back at all, could be kind of telling. we'll be watching this. This should be an interesting story. Make sure you check back with us every day because we're going to be following up on this. Here's another interesting story. Look at how much this is an ETF that follows the banking sector. This ETF is ETFs are baskets of stocks. This is a basket of banking stocks. Notice how after being in this range for a few months, we've broken the support and we are gapping down even lower this morning. So this is aggressive selling. When you see a gap, that's aggressive selling. A gap is when something trades from one price level to another price level and it skips the price levels in between. Shows aggressive selling. Support here is a large group of buyers. There is more demand at a support level than there is supply, or more buyers than sellers. So that's why things tend to stop going down. But when the support breaks, meaning that the market trades below it, it tells us that the investors who created the support with their buy orders are gone. They're out of the market. So anytime you take demand off a market, sets the stage for supply to push it lower. Basic supply and demand economics 101. Less demand throws supply down because if you want to sell, a bunch of buyers just left the market. You're going to have to look for someone who is going to buy it from you, but it would be at a discount. This could be very telling here. Very weak action, despite the fact that we hear from our not so competent members of government, Miss Yellen and Mr. Powell, and the rest of them, the ship of fools is what I call it, after a Grateful Dead song. Now, analysts may say this part of the market's been saved. Politicians may say it. Politicians and analysts can be wrong or they can lie. Stocks don't lie. And if you look at this, you don't need to be a market guru to say, oh boy, something bad must be going on in this sector. Here's oil. This could be a potential trade idea here. Markets that get to support when they're oversold, they tend to bounce. Remember, support's a large collection of investors who want to buy at the same level. Oversold means something has been really beaten down and is trading below what would have been its typical or usual trading range. That tends to bring buyers into the market because they're going to be looking for a reversion to the mean. Reversion to the mean is a very common strategy on Wall Street. We got the double whammy. We got a level where there's already a lot of buyers, and then these oversold conditions could bring more buyers into the market. And as you can see, we bounced there. Now we're back down to the same level, oversold. This is a big move. To me, this is more than just regular trading. This could be signs of like an economic slowdown, which we pretty much know is out there. It's going on. The signs are all around. But that doesn't mean that we don't get a bounce, some kind of a tradable bounce. If you don't trade oil futures, take a look at USO, Uncle Sam Oscar. That's an ETF that's designed to track oil. So if oil starts to rally, that thing's going to follow right along with it, and it trades just like a regular stock. One of the great things these days is that there are so many different ETFs that retail investors can get an exposure to pretty much anything. Commodities, there are inverse ETFs that go up if the market's going down. There are leveraged ETFs that might go up by twice or three times as much as the market. There's a lot of tools out there. One of the things we talk about over here at the Stock Market Jobber is different ways to allocate your capital and what's the best way to get exposure to the various things that are going on. And I just want to bring up Uber because this is the opposite position of where oil is. Oil is oversold and at support. Uber is overbought and at resistance. Overbought, thing is trading above what would be its typical or usual trading range. This is going to draw sellers into the market who are expecting the reversion. And what is resistance? It's a large group of investors trying to sell shares at or close to the same price. There's more supply than demand at resistance, which is why markets, or in this case a stock, stops going up when we get to it, and a lot of times we get a reversal. That's because some of these investors who are trying to sell around this level, the ones who created the resistance with their sell orders, start to realize, oh boy, the stock's not moving any higher. that could be a sign that there are other sellers coming into the market. So I better lower my price, because if someone's willing to sell at a lower price than me, that's who the buyer is going to go to. And you get these snowball effects. So we could have that again here. Every chart needs to be viewed through the prism of supply and demand and market psychology. Now look down here. We have support, support, and the same thing happens here, except for these are buyers trying to get in front of each other, so they keep outbidding each other, and starts this snowball effect. 99% of the moves in the markets are just psychology. If you put on CNBC, they're all going to say, well, the market's up because of this, the market's goes up because of that, the market's down because of this. 99% of the time they're wrong. They just are. They're journalists. They're not former traders, so they don't really understand how the market works. It's very rare for there to be a news story that could actually change things. Could be an earnings report on a particular company, but in terms of the broader market, the only thing that really has short-term ability to move the market, or the ability to move the market in the short term, in my opinion, is changes in interest rates, because they go right to the bottom line. Higher interest rates take money out of the profits of companies. They also create competition, because people might sell their stocks and go into vehicles for income. Higher interest rates mean higher dividends. Notice how here we got support becomes resistance. Resistance becomes support. Got that backwards. Well, this is a common thing in markets. Believe it or not, it's due to seller's remorse. People sold here, and a lot of them regret doing so when the price goes higher. So they tell themselves, oh, I'm going to buy my shares back if I can get them at the same price I sold them at. So we got these remorseful sellers placing buy orders at the level that was resistance. If there's enough, resistance can turn into support. The best traders let the market tell them what to do. They don't come in and say, oh, I'm going to do this, I'm going to do that. They say, what's the market telling me? Now, just say you owned Uber and you buy it down here, and you say to yourself, well, I'm going to sell if it gets to 40. Well, it might get to 40, but there's a good chance it rolls over here. So maybe you should have had your sell target a little bit lower. Then if it looks like it's going to keep going, you can just buy it right back. Let the market tell you what to do. That's one of the keys to being a successful trader. All right, with that, everybody, thank you so much, and I hope you all have a nice day.